So we're going to talk about ways that we can practice Wyckoff, because this is essential to learning. You need to learn how to practice these things. So what I'm doing is I'm just taking my bar replay tool off. I'm looking at wherever price action is. I'm going to a higher time frame. I'll start on the daily. Okay. I'm on the daily. I'm going to look at my market structure points. I can either A, envision these points, both from swing, internal, and fractal standpoints, or B, I can just look at highs and look at lows and go from there. Whatever helps you. Okay, so either A, we can go like this, start drawing out all these points, even if it's not perfect structure. If you want to just kind of doodle them all in like this, okay? We're not drawing perfect structure here. Don't think we are, because we're not. We're just drawing all these points in. Okay, there's a high here, there's a low here, there's a high here, there's a low here, high here, low. We're going to draw all these points in because we're going to use them for practice purposes, okay? We're going to draw them all in. Remember, you don't always have what we call a tradable model on every single one of these points, every single high or low, even if there is a range. Sometimes ranges just dump or just pump without really giving you that classic institutional like Wyckoff, like right over here. Now, here's a good example. Let's look at the first one right here. What I'll do next is I'll go down to a lower time frame or take my bar replay tool close to this range, okay? I'll go like this, and I'll go down to a lower time frame, like the 1 hour. I'll double click on the right. Now, first things first, I need to identify the range, okay? If this was the point here, then obviously we're pulling up to down, okay? So range high to range low. Did it confirm itself? Yeah, it did pretty much right away. You had a swing high form. You had a swing low form. We have the range equilibrium being tested or touched. There's a range. Now, drawing it over to the right, as you can see, the swing high of the range has never been taken out. That's really weird, right? So this was a really interesting one because it's not your typical high time frame Wyckoff model or distribution model, even though price action did end up going lower. We know that because the look at the tool down here, the path tool clearly goes much lower. You didn't really take out that initial high, which is fine because you could have had an internal distribution. That's a good thing to look at. So you don't always get, your swing distribution's not always present, but you may have other ones, smaller ones within the bigger range, in the premium section of that bigger range. Okay, well, let's see if we do have that. So we'll do the same thing all over again. We're going to look at all these various points to see if we see anything that signals a distribution, okay? So obviously this is a point. Price therefore came down to here, came up to here, down to here, up to here, down to here, up to here. Oh, look at that. There was a Model 1 distribution. How do I know it's a Model 1? Well, let's find out. We're going to hide the equilibrium of this bigger range, so it's not in our way. And we're going to zoom in here. We're going to take the bar replay tool back to about right here. Okay, now let's hide this for a second, the path tool, so it's not in our way. And we're going to take the new range tool, and we're going to look at structure here, but we're going to go down a time frame first. Let's go to the 30-minute. Okay, so first of all, since price was retracing back upwards, we're pulling the range from high to low. Okay, but this one obviously didn't work out too well, did it? Because it confirmed and then it blasted up immediately, breaking that range high. So this was a range, even though it's a very tiny range, it's still a range. But ultimately, you had that big bullish candle close right through it, so that's no longer valid. So now we have a new high with a new low right here. Okay, there's your range. So high, low, confirmation. Okay, it's not really a pretty range on the 30, but maybe it is on the 15. It looks a little better on the 15 because there's more candles within it from the high to low. And we'll pull it over. All right. So as you can see, you had the range high being formed as a tap 1. The range low being formed as a tap 1. But then you had this kind of situation where it was curling up, curling up, curling up. What do we know about ranges when you curl up? We know that it's more likely to break down eventually. Okay, so what happened? Well, you had a deviation, right? We had a deviation of the range high. So we know that's tap 2. So 1, we had a 2, and we're going to actually zoom in here. Now, since this is back in April of 2023 and it's currently August, it's not going to let me go to a very low time frame. It'll say that I'm too far back in time. So we can't do that. But what we can do is we can take the replay here once again, like so, and we can try going back to, say, the 5-minute. And we can see why this was a 1 and not a 2. Well, let's figure that out. So why would this have made a model 1 rather than a model 2? Well, let's see. We're going to go and take our trusty highlighter tool and dab once and dab twice to mark those dots so we don't have to draw on our chart like a crazy person. And we're also going to look at, where supply is. Okay, well, let's figure that out. So first of all, from a range supply standpoint, technically this entire thing after this boss was a range supply zone. From this high over to here was a big old supply zone, but it was huge, right? Like that's way too big. So what you could have done is you could have basically minimized that using the downward structure. You could have went down, up, and then down again. You had a break here. We had another break directly under that right here. Okay, so you have break 1, break 2. And obviously, this is now a range supply zone. Okay, but that was hit. It was actually hit on this tap here. In fact, there was actually another supply that was hit as well. Okay, that's true. But notice something else. What reason did they have for making this a model 1? Well, the reason all boils down to this at the end of the day. Okay? Dollar signs. Look at the way this range was formed. What do you have? You have a curve. So guess what? You have stop losses above that curve. Okay? Just because supply was hit at the bottom of the curve doesn't mean anything. There's still a reason to go higher and to take out these liquidity points. Okay? It doesn't have to take them all out, but it could take some of them out. So how would you have known? Well, you just would have watched for structure. Was your range low to range high structure broken following tap 2? Because if it wasn't, there was no reason to look at this from a model 2 in the first place. Well, let's find out. So obviously you could have started your structure like this, up, down, and then called for a bearish break right then and there. But the issue with drawing it that way is that you have to change it because the high wasn't taken at the time. This didn't take the high. So you can't really use that structure. You have to do this instead. Up, down. Do you see how I did that? I can't use these points anymore because it broke bearishly. That's no good to me. Okay, it's no good to me to draw in broken points now. I don't want that. I want to see the only trend that's still remaining intact. All right, so we can't use that. We have to start over. We'll wipe that. We'll go from the low up to this point, down to this point. Where was this point touched again? Well, it wasn't until way over here. Okay, so then there we go. That is the main primary internal structure from the low to the deviation high or the second tap high. That structure, when it breaks, which would be under this low, is what confirms the model 2. Okay? It's better if you break the range low itself, obviously, but this is also acceptable behavior. The better the structure break, the more likely it'll be a 2. Okay? So let's look at this a different way for practice sakes. Now what we can do is we can draw the fractal structure on the last expansion leg between here and see if that were to break. And from there, in a live environment, if we were to watch that, we could even tell ourselves, hey, if that breaks, that might be good enough for us to go short because we're into a supply zone if there was no curve of liquidity above that. All right, so in this case here, I'll start a new drawing. So we went up to here, down to here, up to here, down to here, and then up to here. And then look what happens again. It breaks bearishly temporarily. So what does that mean? Well, we got to skip past all that. We got to go from here to here to here, and then draw it over again, and then to here. Right, so let's do it again. You don't want bearish structure flips. You want to keep the most intact one. So up, down, up. I'm going to use a different pixel size here so you guys can see that in orange. So there we go. That's the most recent fractal drawing. Okay. Remember, every time that I go down another structure level, there's a lesser chance that this is actually going to work from a Model 2 perspective. Okay, every time that we do this. So you got to keep that in mind. You're lessening the chance every single time. So in this case here, unfortunately, this higher low is pretty dang close to this one, which is pretty dang close to this one. So you're in the same boat as before. Useless, right? We can't really use that. So in this case, we can dissect between here and look for a Model 2. Because the first thing that we're always looking at is, hey, is this going to be a 2? We don't always assume, hey, is this going to be a 1? No, we want to look at, hey, could this be a 2? And then we think about 1s after 2s, okay? All right, so we're going to start a new drawing from here up to here. Let's do that. So structure went up, down, up, down, up. We use green structure for that one. All right. So this is as far as I would go with it. You know, I'm sure there are people out there that would take it between here and here, but I wouldn't get that particular, especially because of this reason. Okay. If that wasn't here, then yeah, sure, we could try that. But again, you got to be careful. Just follow your market structure rules, right? And your order flow rules. You can't forget those. So in this case, what happens here? An SFP. So knowing what we know about market structure, the job of this high, for this green high, remember, I'm looking at the green drawing here, which I'm overlaying in red. The job of that green higher high was to take out that low. Because it failed to do so and produce an SFP, this became a weak targeted high. So in theory, if that high is weak, what are the chances this makes a model 2? Even if you do have a supply zone, which I don't see one, but what if there was one? Oh, look at that. I'm sure some people would have marked that out as a supply zone right there. It's not a valid supply because it didn't even break structure, but it's not a valid model 2 short idea. Okay, that's not valid. So let's go back to the 5 and let's see what happens here. So because that high was weak, price action decided to come and take out that high. Now notice something. We didn't actually take the range high up. We should have done that, but notice something else, right? It's starting to take that liquidity point. It's coming up to the very top of that blue box here. We know the blue box ends, so the liquidity curve ends at the top of that blue box. So it may not take the whole thing, but from a model perspective, it very well could be a 1. It's not giving you that classic SFP back in the range though, and I'm kind of cautious about that. I don't like when that occurs. I'd rather just be a quick wick up, like a quick buy to sell, coming back in and breaking structure to give me that model 1 perspective, right? But we didn't get that, right? So we're actually closing above the range high here, which in theory means that this trend is still shifting bullishly. All right, so going back to the 10-minute time frame, we can wipe all this stuff. We're only practicing, right? Because that's how you learn. You have to practice this stuff. So we know that we came up to the high. Now let's see what happens here. What can we watch for to confirm this as a model 1? Well, again, the same thing applies. You have to draw the structure from the low up to that third tap on the high, or from the last deviation low up to that structure pull on the high on the third tap. Now, if there was a deviation here that occurred, aka a tap 2 on the low, well, then you would have looked at the structure between here to here. But because we didn't have that, we have to go from here to here. And that gives you the best way to confirm a model 1 when that breaks, right? So up, down to here, up to here, down to here, and then straight up to here. So if this low breaks, chances are you have yourself a 1. But realistically, this low is very, very close to the low of the range anyways. So it may not actually give you a retrace. It may just die off from there. So that's kind of crappy. So in this case here, if this was a range that you were looking at, then you may opt to dissect the last expansion leg and wait for that to break instead. So between here and the high itself, between these 2 red circles, this one and this one, right? Again, because we're going with a lower structure drawing, or at least a lesser important structure drawing, you're basically limiting yourself there, right? So the chances of it working are greatly reduced every single time that you do that. So in this case here, on the 15, it's a straight shot up basically. On the 10, you do have 1 higher high and 1 higher low if you were to go from here to here and then up to here. Let's check the 5. Looks a little cleaner on the 5, right? So I call that more like a 5-minute higher low than a 10-minute one. And essentially, if we were to break this low, then yes, we can start looking for shorts. But until then, you can't really justify that unless you want to take the more dangerous approach to Wyckoff, right? Which I'm not teaching in the course here. So in this case here, doesn't really seem like it wants to break, right? So the follow through following tab 3 is kind of poor. It's not really the kind of follow through that you'd like to see. So it makes you wonder, could this actually turn into a more extended model? And that does happen, right? Whereas this was quite the break. It could actually turn into a bigger model where it takes the high one more time because this high was never taken out. Is it what I call a tradable model? I mean, not really, considering it from this range, because there'd be 4 taps technically that are higher than one another, 1, 2, 3, and then 4. But you could kind of think of it from a new range perspective, like this is your new distribution altogether, and just kind of start a new range. That's a fine way of looking at it. I wouldn't really think of it, in relation to this bigger range anymore, though, in that perspective. We'll have to see. We don't know what's going to happen yet. Okay, so it actually wicked into here and it closed below. So as of now, we could make that higher high, right? Or we could just come down. We'll see how this plays out. This was a pretty brutal one, wasn't it? But if you notice something, what happens in between of these models? Well, you're always going to have models within models. Like, for example, look at areas like this. If you ever see like a rounded off area here, a rounded off area here, there could be a distribution that occurred right there. Look at that. Or an accumulation. So if you get curious when you're back testing, you can go back and actually look, right? So in this case here, what did you have? Well, you had a model 1 distribution, didn't you? Right? Because structure was doing what? It was forming in an upwards fashion. So if we take our path tool from this low, you came up to here, down to here, up to here, down to here, and then up to here, and then down to here, right? So what did you do? You pull your high down to your low. This would have been the original range, right? This was your original range, and then it took the high right away. So that was tap 1. This was your tap 2, and then obviously you deviated to low once. So you had tap 1 here. This was a deviation. That was tap 2. So you got one, and you got 2 taps on both sides. And then look what happens. It produces a model 1 accumulation before it hits the distribution, and then it goes down from there. Ooh, that's an interesting one. I like the way that looks. So let's go down to the 5-minute and look at this internal Wyckoff model. Right? So you took the high. We're going to mark each one. You have a tap on the high, a tap on the high. This was the original low. And this was the deviation. Now notice what the deviation on the low did. It didn't actually break structure from the high down. So you went down, up, and then down, and then lower high, and then lower low, which was a key sign because you didn't break this high. It was a key sign for a model 1, if anything at all. And that's what happened here, right? So you tap 1, tap 2, and then it came down, and then it reclaimed the range, the new adjusted range, right here. Right in there, reclaim the range low. So, unfortunately, you would have had to wait for this guy to break, which was way over here. So that wasn't really worth it, right? To even find a long. Unless you were to enter a market, assuming that it had to work, that was the only way to really score this trade, unfortunately, that long. But it was a very nice example for practice sakes. So we had 3 taps on the high. We can actually change this to green. 3 taps on the low, rather. We can change this to green. So we had 1, 2, 3, the target being the range high. And the objective of this accumulation was to do what? Was to come up to finish the distribution. So you had tap 1, tap 2. You would have moved your range high up after tap 2 because it came back within the range. And then you would have pulled it over like so, right? It took the last tap over here, tap 3, took out tap 2, and it gave you a structural change in the process. So drawing the structure upwards, it actually broke that structure right here on that leg. So A, you could have marketed in on that break with your stop above this high, or B, you could wait for a mitigation of a supply range. In this case here, I would have used this internal supply range because it was the only one that caused the break. And I would have went like this. I would have drawn that over, waited for price to pull out of that supply range, and then I would have entered from there. Right now, of course, this is a more elaborate one. It didn't go all the way down to the range low before it did what again? Before it produced yet another accumulation schematic. So as you can see, Wyckoff is everywhere. So you're going to have these models that are very tight like this. Look, these little tight $50 range models. You're going to run into this all the time. Should you be practicing these ones? I mean, not really. If it was me and I was learning this, I would be practicing, 5-minute ones, 10-minute ones, 50-minute ones, because you're going to have thousands and thousands of these every month, right? Across various time frames on any asset. So it can lead to problems, right? You're going to have problems if you're trading these little $50 ones all the time, especially with the cost of fees of entering via market, etc. You're not going to have as much confirmations with the lower time frame models. I can promise you that. The reason why is because there's less structure available the lower the time frame that you go, especially when it's volatile. Okay, less structure develops. Or when it's very, very volumeless, you'll notice flat candles, and flat candles means no structure either, right? So we can't use that either. But anyhow, we have a very nice example here where it went from a temporary Model 1 accumulation to a Model 1 distribution, right? Very cool how that works, right? So after that, the objective was finally hit, which was the range low over here. And then that would have been it. The model was done by the time we came over to here. That was the final objective of the model. And then from there, you would have just wiped that model and then went from there. So as you can see, marking all these market structure points out really helps because you can basically see these models present themselves everywhere. So look what happens here. On that bigger model that we were looking at, it ultimately did come back and took that high again, which technically was a fourth tap. Well, why? Well, because you had this remaining, right? So if there's a reason remaining, then that's more than likely going to get taken out. So in this case here, that was an interesting one, but let's cancel that replay and let's look again. Put the path tool back on, and we can actually go back and look at other ones here as well. So again, any structure point on any time frame, all these pivot points here, this is where you're going to be really interested in practicing these models, right? Here, all these circled areas is where you'll see them the most. A good way to identify them as well is if you go to like the hourly time frame or 15-minute time frame, and you see a series of like wicks, like right here. You see how you see like a wick here, and a wick here? There you go. There's probably a Wyckoff model, right? Especially when one wick goes lower than the next. You have to see this though. You have to see one wick going lower or higher because that's the key criteria for any Wyckoff. Here's another one, an accumulation model. Let's look at this one right here. Let's go back with the replay. Let's go to the 30-minute. We have a swing low and we have a swing high. Why am I pulling low to high? Well, because it's traveling down. Price clearly is traveling down on a swing perspective and an internal perspective, right? Traveling downwards. So low to high is the way that I'm drawing it. Okay, you took the low and then it reclaimed the range. Let's go to the 10. This is an interesting one. We're actually going to go and look at this little on a lower time frame. This is a good one. It's a quick one. It's a quick model one, but it's still a model one nonetheless. So you had your tap one being the range low forming. You had a tap one on the high. Remember, you can always watching both sides. Price was curling down. Okay, so the return to zone, if you're looking for longs, is favorable because you have that curling down effect from high to low in the range, which is great. Now, look what happens. We're drawing the structure from the top down. So it went from a down to up, came down again, up again, basically down again, and then up again, and then down again. So really, you didn't really have any kind of structure that you could have watched a break on the 5. It was a straight shot down right here into tap 2. That's no good. So let's look at maybe the 3-minute instead. Okay, now we can see a little bit more. So why did this make a 1 and not a 2? Well, the answer is right in front of us here. Watch. So down, down, and then up. There's your deviation. There's your tap 2. Because it came back within the range, you can now pull this chart down, or the range down rather. So I'm pulling the range low down. Okay, cool. Look what happens here. Supply is still being respected. Okay, supply is still being respected. And what happens? It doesn't break structure. Okay, it doesn't break market structure at all. This was the break of structure line right here. Because it couldn't break that high, there was no reason to even look at it in the first place. So what does structure do? It just maintained its bearish stance until it was ready. And then what happened is structure went lower high, lower low. And this was the second deviation right here. Okay, now you wait for this to break. Once that broke, you could have looked for involvement off any demand range. Okay, there's a demand range right here that was remaining. You could have got involved off that demand range, entered long. I would call that my 1, my 2, and this would have been my 3. Okay, and there you go. Perfect example of a Model 1 accumulation. This is the wonders of having the bar replay because you can go back and look at all these models, right? Very easy to see once you do a few of them. Okay, very, very easy to see once you do a few. So the objective of this accumulation is to do what? Is to hit that range high. Let's see if it hits that range high. Very close. Looks like that would have been a heck of a long one, but still hasn't taken out that high. Whew. Very, very close though. So anyways, by the time you come up to that range high and you flip your structure back to bearish, you could have closed that trade anyways, right? You don't need to hold on to it for eternity. There you go. So it ultimately did take the high, and then ultimately it came into this bigger supply range over here on the left, which was notable on a lower time frame, right? So from there, again, you could have went down to a pivot point like this and looked to see if there was any kind of distribution, right? Or accumulation that occurs after the fact on the downwards pull. Could it reaccumulate right here? So obviously going with your bar replay tool is a must-have when it comes to this kind of thing. Am I always looking at Wyckoff? No, not necessarily. Like I'm always looking at ranges, right? Always looking at ranges. But do we always have to trade Wyckoff thinking and anticipating Wyckoff? Not necessarily, right? We're using it for that directional bias for the most part. We're trading structure, supply and demand in between, obviously, and liquidity, right? This is just a cherry on top, if you will. But it's a very good way to practice, right? Being able to identify where these models are. And here's another one, right? Here's another one. They're all over the place. So if we look at this, 1, 2, 3, watch. 1, 2, 3, off you go. Right here, right? I'm sure this could have been a model as well. Maybe it came into a demand range right here. Yes, it has, right? After it broke structure. So tap 1, tap 2, which always takes 1 in both models, okay? And then what happened? Well, your structure was down, up, down. Following tap 2, you got that bullish break in structure, and then you had the demand range right here, right? And why is that my demand range? Well, because structure goes up, down, up, then obviously that's my demand range from left to right. And that's what mitigated, with the target being what? A target being a sweep on these highs, and possibly even this high. It came very close to the target and then just missed it and then went back down again. But there you go. You have tap 1, you got tap 2, and then you have the structure break, which is a must-have for a Model 2, and then you have your tap 3 in the mitigation zone. Great. That's exactly what I like to see for a Model 2. You'll also notice, again, if you go back testing all over the place, you'll notice like most notable highs or lows, they have Wyckoff all over the place, right? And Wyckoff here, 1, 2, 3. Wyckoff here, 1, 2, 3. 1, 2, 3. That's a Model 2, but it's not only a Model 2, it's also a Model 1. It's a Model 1 that turned into a 2 at the last minute and gave you one more retest. Look at that. Isn't that cool? Right? Over here, again, you have 1, 2, 3. Let's look at this one. This is the summer of 2021. Let's look at that right quick, actually. Look how low that third tap went. Look how low that went. That's really weird. So let's see what it came back for. Did it come back for something is my question. Let's go back with the replay tool. Let's go to the 12-hour. Let's draw this range in. Let's pretend this is all that we've seen. Okay, let's say that's all that we've seen at the time. And we know that's in a downtrending environment, so range low up to range highs is how we pull the range. We draw it over. Okay. Range low being formed is my tap 1. Deviation of range low, obviously being my tap 2. Structure did break bullishly. Right, so from the range high upwards, and I'm not going to go from all the way over here because I'm not using the primary range structure in this case because it would have been this high. That's silly. I would have investigated the leg between here and waited for that to shift. And once I seen that shift right over here on this boss line, because obviously structure was down, up, down. Once it shifted to bullish here, then I knew right then and there, price is allowed to retrace all the way back down again to make that higher low for the higher high. So where would make sense to retrace to? Well, again, I told you guys that Bitcoin, when you have what you think is a Model 2 setup, a lot of the time it will come back for either A, a demand range if it has not been mitigated, or B, if there's an order block with imbalance remaining and directly coming off your tap 2 expansion leg, it has to be right off the beginning of that tap 2 expansion leg between here and the first up thrust, between here and here, I would say. So anywhere's on that first leg up following that tap 2, between here and here, if you see an order block with imbalance that has not been tagged, then that's where you're going to be looking for a reaction from, okay? Otherwise, you'd have to use a demand range. But in this case, let's see why, because it kind of looks like it came down. It broke the structure over here, came back for a order block right here, just a standard 1 candle block, but it made a lower high. It didn't make a higher high. So why did that happen? Well, let's see. Is there something that was left on this leg here is my question. Well, let's find out. Well, there's a 3-hour order block with imbalance, but that was already hit. What about 2-hour? No, same thing. What about 1 hour? Oh, wow, look at that. There was a miss on this 1 hour demand. Look at that. It just missed that 1 hour demand zone. So yes, there was a reason why this demand range didn't have to hold itself. There was a reason, a very valid one. But before we get to that reason, which, I mean, we just kind of showed it, but before we show the result, rather, look at this. you had a reaction off this demand range, but when you had that reaction off this demand range, you had another Wyckoff form right here. Beautiful, right? Range low, range high. Tap 1, tap 2, tap 3. Model 1 accumulation, you would have adjusted that up, you would have adjusted that down. Did it hit the target of the accumulation? Well, yeah, it hit the range high, sure. And it also filled all the inefficiency directly above, here, here, and here, before ultimately going down again. Perfect accumulation, Model 1. Absolutely beautiful, right? That's what I like to see. All right, so let's see what the end result is here. Did it come back for this 1 hour demand? Let's go back to the 12 hour. Wipe all this. Oh, look at that. So the reason why it came back before fulfilling its objective for the next all-time high was because there was a little bit of demand remaining down there that had a little bit of inefficiency, obviously, because it wouldn't be an order block with imbalance otherwise. That's what price needed to hit for that third tap. So this would be my 1. This was my 2. Here was my break of structure on the 4 hour, which isn't really a break on the 12, but it's still a break on the 4. And then we have our third tap right here, which is the higher low and the demand mitigation for the Model 2, right? Very nice. High, low. Tap 1, tap 2. You would have moved this back up after you took that range high. Okay, cool. Taking that over. Tap 3. You got closure back within the range. You got a break of structure here. You got a break of structure here. This one was obviously the better one to break. This was like telling us that it was probably time to start looking at this from a Model 1 perspective, but this was the for sure Model 1 line, I would call it. It even gave you that final retest right here, right? Beautiful retest off the newly formed supply range, and then down you went into the accumulation zone. So you went from a distribution directly into an accumulation to come back up for that distribution high, right? Came right back up again. That's how these markets work. Any market works the same way, right? And to top it all off, you had this most obvious return to zone consideration here, this beautiful trend line of liquidity and beautiful reason to even go back down again. So this would have been what I call a high probability Wyckoff distribution model, right? Because of this. This would also be what I call a high probability accumulation model. Why? Because of this. Look at the curve. Look at that return to zone for the longs. Can't get better, right? You really can't. You cannot get cleaner than this or more probable than that, right? That's the best return to zones I've seen in a long time. Look at those two, right? So I hope that helps clarify how to go backtest, right? This wasn't necessarily to show you guys how to identify. This is to show you guys how to actually find these models in the first place so you can start practicing, because you're going to need to practice these things. Practice makes perfect. Don't expect to get it overnight. You might see something like this and say, oh, look at all those wicks in the high. 1 over, 2 over, 3. Okay, look at that. It came down, but it didn't come all the way down to the range low. That's fine. Just keep going. Keep practicing, right? There's usually a reason why that happens. You need to identify those reasons, right? Remember, you're not trading Wyckoff directly per se. You're trading everything else that I've taught you guys. This is the cherry on top for that directional bias.